What is your buy box? Why is it so important? Success in real estate investing starts with knowing exactly what you want, your buy box, and just as importantly, what you don't want, your don't buy box. Hey folks, this is Mike Zlotnik, Big Mike, and today's conversation is all about real estate investment analysis. Let us start by discovering what is your buy box. Why is it so important? Success in real estate investing starts with knowing exactly what you want, your buy box, and just as importantly, what you don't want, your don't buy box. Investors looking to diversify should think very intentionally about preferences, type of investments that meet the buy box, keeping your portfolio focused and protecting it from unnecessary risk. Each investor criteria is unique. Some prioritize predictable income, some other focus on growth, and many want strong downside protection. You can leverage your resources, your relationship to access high quality deals without being hands-on as a way to invest. Being a passive investor means you can accomplish a lot of things by finding the right folks to invest with. You start with the jockey before the horse. People who you invest with, people who you know, like, and trust, and then you look at their deals that fit your buy box. Let's talk about looking for bargains. 6 situations where the sellers are motivated. There are moments in market, part of the market cycle, part of motivated seller life events where deep value buys could be achieved. So smart deal metrics could look like this: below market price, on the as-is basis, below reconstruction cost acquisition, where the property is being bought at a steep discount to reconstruction cost, in some cases even greater than 50% discount. In those circumstances, you can start with a great cash flow relative to the cost of acquisition. As an example, you could start with a robust initial income because you buy so deep. Your initial cash flow could significantly outperform a risk-free alternative such as US Treasuries. You could start with the capitalization rate, so cap rate, significantly higher than the mortgage financing. For example, you could buy at 9% cap rate and finance with 7% cap rate. That 2% positive difference is a large margin of safety and a strong initial cash flow. You could look at deals with a conservative debt leverage, manageable conservative levels of loans that will help reduce volatility and reduce risk. Assessing upside versus downside. Seek out asymmetric risk return profiles. Downside protection. The best deals have built-in protections, such as deep discounts, strong location, strong market economics, KPIs that I mentioned earlier, predictable income streams. Look for the upside opportunity. Look for investments that have strong upside without significant risk. That's the whole goal. Rent growth, predictable rent growth with long-term leases, with high credit quality tenants, easy and straightforward operating improvements, avoiding the downside risk. Understanding market cycles and finding opportunities is a critical part of the real estate investment analysis. Market cycles matter. For example, multifamily properties today are at the bottom of the cycle. There are great buying opportunities if you know what to look for. Certain markets, certain properties see significant distress conditions. And there are certain situations where the properties are great, but they're distressed sellers. And those are the better opportunities. Great properties, but distressed seller circumstances, financial pressures, or life events. Another way to look at this is what other asset classes in commercial real estate trade at the high cap rates. For example, open-air shopping centers and certain industrial properties quite often trade at the cap rate significantly higher than the cost of mortgage financing. And these type of properties typically have long-term leases with high credit quality tenants with predictable annual rent escalation clauses. Investments in projects like this can create long-term predictability and downside protection. Some other asset classes, like self-storage, might not be ideal, as assets in that sector might still be trading at the negative spread between the cap rates and the mortgage rates. So knowing what is attractive, what cap rates dominate each asset class, where the better opportunities, helps in making these investment decisions and shaping your buy box. What is also important is to know what to avoid. For example, flashy, complex deals can hide unexpected risks. Focus on investments that are clear, established, and offer reliable operating income, predictability, conservative leverage, and other KPIs. Investments that operate like a business, real estate that operates like a business, properties such as hotels, Airbnb, senior living facilities, they have a lot of operating risk. And some can do really well, and some others could outperform simply because of the poor operation. So it's more of a business than a real estate. Ground up construction, unless they're pre-leased to a target tenant, present significant risk because it's a speculative investment, there's a construction risk, and reliance on future rents projections could be speculative in nature. While if you buy an existing, you have a lot more clear what the current picture looks like today. So it's less speculation, more predictability through existing, deep discount. Again, it's your knowing your buy box. For some people, ground up development is the way to go because they can do it in volume. They may not get their deep discounts, but they can get a lot of land and continue to build. So it's picking and choosing the type of deals that fit or don't fit into your criteria. Comparing alternatives, quality over quantity. Concentrate on the deals that offer truly superior risk versus reward, not just good enough deals. Opportunity cost matters. Is this investment more attractive than the alternative, whether in real estate or other asset classes? So relative comparison matters. You could look at where stocks are trading, what is the level of risk versus reward, and you could look at the deeply discounted deals in commercial real estate. Where's the healthiest risk-reward ratio? That's the way to think about it. So investing for long-term success. For those who are looking to diversify, real estate offers compelling opportunities. But the key is being very selective, defining the criteria carefully, partner with proven operators, sponsors, managers that remain disciplined, seek out investments with strong downside protection, attractive upside, and clear advantages compared to the broader market. Focus on excellence, not volume. Growth comes from choosing quality investments that are aligned with your goals, managed with expertise, selected for their staying power through market cycles. That's how your wealth achieves stability, steady progress, while avoiding unnecessary complexity. Thank you for your time. I hope to speak with you soon again. Thank you.